Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Bidding on this May 21st, 11 a.m. on the East Coast, we have a bit of a frenetic day, as I think Gemini season is now upon us. And as you folks know that are Geminis, it is a tale of two cities. And Dan, Nathan, we're sort of seeing that a little bit here. Obviously, a Dow Jones that's lower. I know we don't get bogged down in S&P that's lower, but a NASDAQ that's unchanged. And, you know, it's just a lot of odd things happening. Hello.
Why did you say the Dow Jones Industrial Average?
Why?
Do you know that?
Then I said, if you'd listen, that I know that Dow Jones doesn't matter.
All right. But that said, you know, there's you're a Curb Your Enthusiasm fan. That'd probably be no.
That's my favorite show. I'd love that show.
So Guy Adami
never
has
seen
never
it.
seen a single episode of Seinfeld.
Seinfeld.
But Larry David, who is his collaborator on the show, Seinfeld, he's got the show guy that just ended after 20 years called Curb Your Enthusiasm. But
20 years?
You know, 20 years on and off. I mean, there was like writer strikes, there was this, that, whatever. But literally from the first episode to the last episode last year, it was a 20-year span. And there's a really funny season where they're going to do this Seinfeld reunion. And it's kind of meta. They didn't really do it. But in fact, them all being on Curb Your Enthusiasm was a Seinfeld reunion. You get it? But there's this bit where Larry David and Jerry Seinfeld, they're saying, do you ever notice, because that was the whole, you know, thing about Jerry Seinfeld's stand-up, do you ever notice that people are saying, with that said now? Like, so they say something and they say, with that said.
I do that.
So it's like, well, the thing that you said is like, why does it need to be qualified? With that said, yada, yada, yada. Okay. Yada, yada, yada was something from a Seinfeld episode also. So a lot going on there. Guy,
hold on, but before we even
on my main page, it's not even on my main FactSet page.
We have to mention
I couldn't tell you where the Dow Jones Industrial Average is trading.
We're 2 minutes into the show. By the way, it's Wednesday, and if it's Wednesdays, as our viewers know, Dan, bitch, yes, it is. It is Butters Day as well. By the way, this is from Chris L. We'll start the show with a question. Two-part question for Guy. And Chris obviously knows how to push my buttons because I have railed against the two-part questions forever. Does this selling feel very programmed and organized?
Ooh.
But this is the good part. Secondly, is it friggin' Butters?
Yeah, but by the way, this is a perfect two-parter. And you know why two-parters are not a problem in our chat? Because it's just like, it's not different than when you're asking on an earnings call. You know, they allow for a two-part question, right? You say, you know, congratulations on the great quarter, which also bugs the shit out of you. I know that. Analyst does that. He says, first, I'd like to ask about the margins. What was some of the pressure? And then I want to follow up with, you know, yada, yada. Okay. So that happens. You know, Guy, you just said Gemini, and I'm feeling like that's some cosmic stuff. What is that? What do you call those things? When each month you move into your
zodiac,
you know, zodiac signs. Today, we're just going to go off script here. Google is up nearly 5%. They had their user conference yesterday, the I/O. Maybe Amanda can throw the chart up there because it's going to show you a little bit about this level. We talked yesterday about that 200-day moving average as resistance. You can actually just draw a horizontal line a little bit from the left to the right. You see that we're breaking out above that. Sentiment has been really bad in the stock. A lot of it has to do with Gemini and some of the kind of products and services that they have launched or actually haven't launched, right, relative to what's going on with some of their peers. So, you know, we looked at Microsoft yesterday getting up to that prior all-time high, which is kind of interesting to me. And then you look at the Gemini and you say to yourself, Alphabet, much better valuation, you know, maybe for good reason why the thing has been in the mud here a little bit. But if investors are starting to come around to their product offerings, and it took them like to see an IO and a bunch of them. One of the knocks has been over the last 2 years, they've been doing these product announcements and they really haven't followed through particularly well with what those products are. So on a relative basis, it's been in the doghouse. We also talked a little bit, I think you mentioned it yesterday, an analyst from Melius Research, Ben Reitzes, who was basically saying they're faced, let's go back to the Google, with this existential threat, right? headwind to the blue links, the search results, the advertising revenue associated with it. So I think investors are feeling a little bit better that they are launching this AI mode. If we can go back to the Google, Steve Rafis, back to the Google. Amanda, who's doing well, by the way, she is going to be on maternity leave for a while, and our main man, Steve Rafis, is stepping in on the charts, but he's a little rusty guy.
No, he's not. By the way, wasn't Stephen Rafis I always pronounce it incorrectly. You can pronounce it for me, but a finalist for the men's premier, the Tewarton Award, right? I mean, that's pretty impressive.
Yeah, I mean, Steven was a great lacrosse player. I think he kind of hung it up. He played in the PLL for a couple seasons. I think he was like rookie of the year in the PLL a couple years ago, or he was in contention for it. But you know what? He's as good of a guy as he was an excellent lacrosse
player. He had a great
player.
interview with one of the Kavanaugh kids from Notre Dame.
Oh, yeah.
I just recently saw. You might check that out in your favorite podcast store.
Yeah, he's been doing a lot of great stuff with First Class Lacrosse, Deemer Class, founder of that company. But back to Google for a second here in the Gemini. Guy, is this a stock that if you could say, and people have been saying this about regulatory for years, they've been basically saying 4 years, FOR, not for FOUR, that eventually, yeah, it might matter, but it doesn't matter right now. They're in the remedy phase with this suit. You know, the product stuff has put them in the doghouse a little bit. Has the sentiment just gotten way too bad in this stock?
Remedy, a great song by the Black Crowes, number one. Number two, yes, the sentiment's probably gotten too bad. We actually talked about it yesterday, the fact that, you know, we traded down the levels last we saw in the fall, and we've seemingly have bounced. If you can, and I'm not convinced of anything, by the way, put regulatory on the side for a second, because that's always sort of been hanging like the sword of Damocles. By the way, Google that if you don't know what it is. But if you can say to yourself, you know what, I don't think this existential risk in terms of AI and search is going to manifest itself, then Google is just flat out cheap here. But if you think that, you know, AI is going to be sort of the existential risk that Google's not going to be able to combat, then it's somewhat problematic. Here we are at the 200-day moving average. I think this is a reasonable place to sort of think about taking profits if you've been long the stock. But, you know, that's a decision you have to make. And I'm not smart enough to figure it out. I will tell you, I think Gene Munster, we had him on Fast Money last night. And you know, he didn't talk about Google being the Eastman Kodak, but he sort of compared it to eBay. And, you know, potentially they may have to sort of, I don't want to say reinvent themselves, but they're going to have to sort of pivot to something at some point.
Guy, are you tapping? Are you tapping?
No, I'm not doing it. My hands are right here. I'm not tapping anything.
Gene,
I am sitting here.
I'm just saying, God.
No, I mean, I don't tap. I'm not a tapper.
Jake Tapper just wrote a book about the Biden administration.
He's getting killed by people. Like, did something happen? I mean, geez.
Well, I think the timing of the book now is something with obviously the diagnosis with prostate cancer of Biden, but you know, there's a lot of conspiracy theories out about it, and I think the timing is maybe something that was bad. Gene's going to be on the podcast drops on the 28th, guy, on the morning. That is the day of NVIDIA's results, so it'll be
it's next week. That's coming to a theater near you.
You know what I love about Gene, and you know, you and I've known Gene for a long time, and he was this perma bull in Apple for years and years and years. And by the way, it was probably the right thing to do, you know what I mean, to be a perma bull over the last 10 years. But he's been very constructive on Gemini in general. He thought they would get their act together. He doesn't think it's like right now the threat that a lot of folks, you know what I mean, have thought it was going to be to their ad revenue business. So I just wanted to throw that in there. So last night, guy, I'm waiting to go into a restaurant, and with a couple folks, a guy comes up to me. He says, big fan of the show. You hear that every once in a while, right?
No, I don't.
He pitched me a stock, which, by the way, normally we get pitched stocks. Man, to pull this thing up, TMDX. This is not an endorsement of this stock, people. A guy on the street pitched me. It was like Shark Tank for stocks. Really nice guy. Now, this is like, I expected this to be like a $300 million market cap stock. This is hold on, I'm going to tell you what it is. It is a $4.2 billion market cap stock, and they actually have real earnings. Oftentimes we'll hear about a stock that some guy wants to tell us or gal tell us about. This company is expected to have net income of $70 million. Not a whole heck of a lot, but at least it's positive. Okay. On a GAAP basis, it's $1.77 in earnings, but it also has revenue. And I'm going to tell you what this company do. It's got $580 million in expected revenue this year, 700. So next year, growing 31% this year, 20 next. Okay. And I say to myself, all right, that's worth looking at. Do you agree with that? If you get like a name like, I've never heard
No,
of TransMedics.
couldn't pick TransMedics out of a lineup.
I don't know this TransMedics. I don't know what it does. And I'm not, again, this is not an endorsement, but I'm going to tell you what it does. Hold on a second. Give me a second here.
By the way, as you're looking for that, CC, not Amanda's daughter CC, but RCC, said Dan getting mad at Guy for talking with his hands is anti-Italian bias, and I don't disagree with that.
What does that mean? Okay, so the company offers.
But I wasn't tapping anything. I mean, you see me. Look, I'm going to have my hands here the whole time.
All right, maybe it's Bill again. The company offers transplant therapy for end-stage organ failure patients across multiple disease states. TransMedics Group serves patients in the United States. So what he said to me was they're a delivery system, or however they deliver organs, which are obviously very important for transplants. The product extends the life of those organs.
Oh, okay. I see. Okay. Got it. Now I understand.
And you know what? Also, one of the guys I was with said to me, you know, that Blade service, the helicopter service that you hear about, looks kind of fancy. It takes you to the airport, takes you to the Hamptons or whatever. I guess a disproportionate amount of their business is transplanting or taking. All right. That was, is organ delivery and stuff like that. So again, I thought it was kind of interesting.
We've really gotten off the rails here.
Oh, I just think it's it. Listen, you and I love hearing from listeners, and we love hearing what interests them. And usually we'll hear something about some sort of really micro cap stock that they want us to talk about just so it moves the thing. This looks like a real company. That's all I'm saying.
Okay. 12 minutes in, Amanda's like, I'm sure she's just beside herself.
Well, we did talk about Google, which I thought was interesting.
It was a good conversation. To me, though, here's the conversation. Look at this slide that Amanda made. It's the chart of the day, which I sort of dig. And this is from Ray J, we used to say in the business. But stocks struggle when yields are this high. And we will look at a yields chart in a second. But this is something we've been talking about, and it's what I find fascinating, not to use the interesting word, is last night on CNBC's Fast Money, we had Steve Leisman on, and I asked him a question about the Japanese bond market. They just had the worst bond auction since 1987. And if you read Peter Bookmar's work, a lot of people are coming to the realization that something is happening in Japan. So the U.S. yields being higher today is sort of predicated on now global yields starting to tick higher. And you can read this chart for yourself. But the point we've been making, I think, for a while now is as yields go higher, I mean, it's not necessarily mean stocks are going to crash, but it definitely creates a headwind for stocks. And here we are, Dan.
Yeah. So let me just read this for a second. The data shows that since 2021, the benchmark proxy for the U.S. stock market averages just 1% annual advance when the 10-year trades above 4.5%. With a 10-year rate above 4.6%, the benchmark loses 2.4% per year on average. Losses get much worse when the yield tops 4.7%, with the S&P 500 plunging at an annual rate of 35.5%. Wow, that seems like a lot. That's a crash year. You know what I mean? It's not anything other than that. But the markets prior to this, I don't know. The markets have dealt with 4.5% 10-year yields. For a while, we had 2 consecutive years at 25% returns, 23, 24. You could say, all right, maybe that's being powered by this secular shift, generative AI. The largest companies in the world were a big part of that performance. Last year, 25% of the S&P 500's 25% return was NVIDIA alone. We're just not going to see that participation again. We have Microsoft up 8.5% of the year, Meta up 9.5% of the year. The rest of the Mag 7 is basically down. Apple is still down 17%, Guy. NVIDIA is unchanged. Google's still down 10 or so percent, and Tesla's down, 15%. Those are the biggest names in the index. Let's look at the S&P 500 really quickly. We looked at it yesterday. We talked about the gap on the China, delay, 90-day reciprocal, blah, 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 blah. You see the flat 200-day moving average. That gap is really the thing that happens from here. I think you and I, we look at a 5,900 S&P or so. 6,150 was the high. Let's call it 240 points away. The gap level, if we can just kind of go from a non-static chart, guy, if we can go to a non-static chart for a second, we're going to look.
What's the right term? I mean,
I don't know.
That's a static chart. I mean, it's static.
Know.
It's not moving. I mean,
Rafis, move it.
Maybe Rafis, maybe if a listener or viewer wants to give us a better thing.
He just said that's a live chart. He's getting all up in my grill. What was the gap level? If someone wants to put that in the chat, or we can look at it right here. The gap level, okay, prior to I guess we closed on the Friday before that Monday.
What was it? It was that Friday level, and then we gapped higher. So if we do a shorter term chart, you can,
6150 to the upside, and we closed that day at 50. So guy, it's basically, let's call it 200 S&P points in either direction, right? Back towards those prior highs, or fill in that gap or so. You know what I mean? Or 225 or something like that. Where's your money? Prior highs, fill in the gap. Prior highs, fill in the gap.
Fill in the gap. I think it's 70-30 at least. Fill in the gap. Now, look, the optimists will say that given the bounce that we've had historically, when you see a move of this magnitude in that short of a time, it doesn't stall, it just continues. And I've seen all the data that suggests that's what's going to happen. But the flip side of that coin is when I hear a Jamie Dimon talk, Paul Tudor Jones, we talked about this yesterday, Stan Druckenmiller talk, even a Steve Cohen, who rarely talks, a Ray Dalio, who, by the way, I listened to yesterday at this BNP Paribas conference. They're all saying the same thing in a different way. There are concerns out there around a number of different things. Jamie Dimon talked about the complacency in the market around a lot of things. So listen, as I said 100 times, these are people a lot smarter than I am. Not a high bar. I get it. But they're all singing the same song here, Dan.
Yeah. Let's pull up the S&P, the E-minis here, the futures, because interesting levels here, guy. All right. So they're not going to correspond, obviously, with the cash. And let's just pull this up for 1 second when Rafis gets this. You see the steepness of this V. We've talked about this V. Okay. If you're looking to, let's do a 1-year chart for a second, please. Let's draw that uptrend. Okay. You'll see the steepness of it. You see that 200-day moving average. If I am looking to play for a retest of that uptrend and then possibly a break, then I would be targeting like a 5,600 sort of level, guy. Okay. And let's draw a horizontal line from, right there ish. Okay. That doesn't really matter. Let's look at the 200-day moving average, which actually lines up with
that's exactly it.
Yeah. So that's the level. So if I'm looking at the E-minis here, guy, and I want to press for a break below that, uptrend, and then obviously the next level would that be that 200-day moving average. I'm probably stopping at 6,000. Does that make sense in a way here? If we're like 59.45 right now, I want to use a 6,000 stop or so.
Whether it's 6,000, and this 6,000 is probably the right level. I mean, it's around there. I mean, it's, as they say, it's close enough for government work. It's a tight stop against a potential break of a trend line, which I do think if it breaks could potentially accelerate, which means you can continue to lower your stop, a trailing stop. I mean, that's the way you play this. We'll see. Now, I don't know what just caused the little run up in the broader market, specifically in the NASDAQ over the last, I don't know, maybe hour or so. I mean, something obviously happened, but I'll figure it out. But, here we are. The resilience of maybe it is Google. The resilience of the market is noteworthy. However, the headwinds of the market have not abated, Dan. They continue to be there. And I tell you, got home last night to the headlines that Israel is planning a strike on the Iranian nuclear facilities. I'm hard pressed to understand how that is bullish in any way, shape, or form, and how a VIX at 18.5 somehow encompasses that. But that's just me. Maybe cooler heads will prevail. But it goes back to what Jamie Dimon's been saying over the last week or so, and some of the things that I heard Ray Dalio say and all these other people about debt and debt concerns. It doesn't paint a particularly rosy picture.
Yeah, the one thing about targeting nuclear facilities, especially at a time where, this administration is trying to negotiate an Iran deal that they actually pulled out of 7 years ago or whatever it was in the first administration. The Israelis threatening this really undermines our negotiating position, if you think about it, because one of the red lines has been, it's one thing to kind of send some bombs over, things that are going to be intercepted, or kind of, target some military facilities that, hopefully, again, hopefully you don't suffer, like some sort of fatalities and the like, because that escalates it. We saw that with Israel in Iran last year. I think it was last year or so. So if they're going to target nuclear facilities, as we're trying to do a deal, right, to kind of, slow down any, sort of nuclear capabilities that exist more towards a bomb, it's just bad politics right now. You know what I'm saying? It's just not policy, bad policy. You know what I mean? Like, so, for whatever that's worth, the last thing I think anybody wants is some sort of elevated geopolitical risk. Guy, this headline just hit the tape. It's not something that maybe surprised you as kind of a bull on gold. Bitcoin, new all-time high. Bitcoin, new all-time high. Let's press that. That has a lot to do, I think, with regulatory sort of stuff here. But, 109,000. Kind of interesting stuff. Let's move that over a little bit so we can see where the level is. Now let's make it a 5-year. It's come a long way in a short period of time. I think you and I were both in the camp that we would have a gap fill going back to November. That kind of happened here. So now we have this move to the prior highs. I don't know, man, like 75,000 to 109,000. Are you playing for a breakout here, no matter what this risk asset is?
A lot of people are, clearly. I mean, this is the levels we last saw in January. It's sort of the peak of everything when there was all the enthusiasm. Then we traded down to 73,000, which was the moving average. You just said it filled the gap. I am again surprised by how quickly this has recovered. But, what's it recovering on? I mean, I do think the recovery here is on the debt concerns that we've been talking about for a while, and the fact that bond yields are moving higher somewhat. I think that doesn't make a lot of sense, but I think the fact that the bond market is seemingly on not particularly solid ground is encouraging Bitcoin hodlers, and I think that's what we're seeing.
Hodlers.
I don't even know what that means, but I figured
that means that they hold. That means that they have diamond hands, guy, that they don't sell. You know what I mean? In the volatility here. Should we get back? Well, I do think the Bitcoin is worth like looking at. I also think Google up 5% is not something that a lot of folks suggested. We talked about, what was coming out of IO last night. The stock was trading up, then it was trading down. People wanted like an update about like search and what we heard from Eddie Q from Apple. And that was the thing that had it kind of flat. So a day like today, you're seeing money into Google. Maybe it's coming out of, Microsoft a little bit, but the rest of the Mag 7 are starting to move. Meta's, let's pull up Meta for a second. It's up 1.25%. I think that is interesting also. So I don't know. I mean, the Mag 7 leading to the upside. Is that interesting? Possibly.
Yeah.
Yeah, go ahead.
What's more interesting to me, though? We just spent a few minutes on bond yields. And again, I think you know where I stand. But the flip side of that coin is the US dollar. So I know we have that chart in the deck. I mean, pull that up, because the sell-off is seemingly starting once again. And that's something to be concerned about. I mean, the dollar had bounced, probably rightly so, but now you're starting to see the turn lower again. And you have to ask yourself, I mean, what is the environment where you see dollar weakness and bond weakness at the same time? It typically doesn't happen. They typically run in tandem. If yields go higher, typically means the dollar's going higher, and vice versa. You're not seeing that now. So something is askew here. And, I think we've given the reasons why around this as well. Obviously, the equity market seemingly does not care about this. I don't know at what levels it starts to care, but there's something going on here, Dan, that's making the bond market sell off, number one, and making the dollar sell off as well.
Yeah, I mean, I guess it is this sort of sell America risk assets, the end of, American exceptionalism and stuff. And, every time you hear those sorts of proclamations, sometimes you want to go the other way. But what's clear here is if we do see a Dixie, we do see the US dollar index break those lows. If we do see a 10-year yield at 5%, that means people are selling dollars. It means they're selling treasuries, but one of those sorts of things, and this was evident in the the lows in April, some of the hardest hit names were some of the largest names in the stock market, which is also a sell America trade, because a lot of these sovereign wealth funds, right, were basically, like they were doing this kind of, this trade where, they were, picking up the spread in yields, and they thought it was a take at the bank sort of trade, and they were buying, the highest yielding, or at least the best performing sort of names, and that was the Nvidia and the Mag 7 and everything like that. So those were being sold. So that's, to me, another sort of disconnect that you see. Guy, I got to eat some crow here a little bit. I was very, very negative on Coreweave for a whole host of things into that IPO. The stock just topped $100. It's trading at 105. It's up 15% on the day. The IPO, I think, came at what, $38 or $40 or something like that. It immediately broke. But the narrative was, and it was something that I was pushing. We talked about it on CNBC. I'm happy to talk about it again. I'm happy to admit when I'm wrong on something. Here's the price action, right? It's become a meme stock. And I guess, when people want to take the other side of this thing and they look at a low float, they look at high short interest, they think about all the things that have said, at least the reiteration of CapEx by the hyperscalers. And now the headline today is that you're seeing, demand that has increased. Well, we'll see about that. But if the stock is moving like this for the reasons that I just mentioned, maybe it's a short squeeze or whatever, and the demand doesn't materialize, you know what I mean? And that's something that I've been on, and maybe I'm wrong about that too, about demand for, data centers and the like. So next Wednesday, NVIDIA, Jensen Huang has been all over the place. You know what I mean? Like, he's been in Saudi Arabia with the president. He was in Singapore the other day. He's talking as much as you would not expect, but much more than you would expect in a quiet period prior to earnings. You know what I mean? So I think that's helping this stock and some of the other names in this kind of data center trade.
For you Shakespeare fans out there, the lady doth protest too much. Remember that?
Like which one was that?
I don't know. It might be Hamlet. I apologize. I probably should know. Apologies for you, Shakespeare.
On the spot with that, I think it's going to be Jacob. Jacob's going to be Johnny.
Jacob's good at this. He can. Anyway, my point is, the point around that is, I was right. See that? It's pretty damn good. My point in bringing it up is, when people talk, what are they sort of guarding against? And I think that's something, listen, we're going to know a lot more in a week, so we'll see. What we need to talk about quickly, though, is a couple earnings releases that we saw, and Target continues to suck. So I don't want to spend too much time here, but the amount of people that have been saying, to buy Target on a pairs against Walmart, or the relative value of Target versus Walmart doesn't mix, all those different things, it's just not coming to fruition at all. And they continue to disappoint. I think there's going to be a continuation of that. We're not seeing the lows that we saw in early April. Personally, I think it's just a matter of time. Again, you don't want to play the valuation game here in Target, because if you've been playing that game, you've been losing now for the last 3 years, Dan.
Yeah, and you make a good point. It didn't break those prior all-time or not all-time, but 5-year lows. I think in the early April, it got back towards those COVID lows. If we want to go to a non-static chart for a second here, Steve, and I look at this sort of price action on a day like today. Let's go a bit longer so we get the COVID. We get the COVID lows here, even a little longer, maybe 6 years. So I look at this guy and I say to myself, okay, there's a lot of room down there to the 18, 19 lows. And your point about valuation is a good one, but stock, if it were to close up today, you might have the potential for, I don't know, a move back towards, 110 or something like that. But I think that's something you probably fade, especially if it's just about sentiment, the reason why it's rallying, because, the quarter was bad. The guidance sucked. You got to be worried about their ability to manage inventories and the like, as well as, let's say, a Walmart or a Costco or something like that. So again, I think you fade a big rally, you know what I mean? But it's not something.
It's worthwhile. I mean, it typically you have it in front of you. I don't. It typically trades about 8 million shares a day. It's probably done that already, if not more. To your point, if it were to close positive, that would be encouraging. It's going to take a lot for it to close positive. You're probably still 3.5%, 4% away from that, but we'll see. That's one. So again, we've talked about it. It's still, for me, Walmart over Target every day of the week. The other thing I think we need to talk about quickly is the home builders, because Toll Brothers reported last night. There was some excitement around the report. The average selling price was a little bit lower, but seemingly things are hanging in there. This, obviously, if you look at Toll Brothers, the average price of a home is approaching $1 million. So this is the higher end buyer. So they're not as affected as some of these other home builders without question. But with all that said, rates are going to matter. You brought it up last night. And at a certain point, if the unemployment rate continues to sort of tick higher, they're not going to be impervious. They're not going to be sort of insulated from that either. So the price action today in Toll Brothers is absolutely worth watching.
Let's pull up an XHB, the ETF that tracks, the home builders index. And, by the way, that looks a little constructive, that Toll chart. What I mentioned on Fast Money is that, the 30-year mortgage, is like 7% right now, right? With a 10-year at, 4.55. And you can say whatever you want on the high end, but, most folks, like borrow, they take mortgages out, even if you're buying $1 million house. Like the idea that there's a cash buyer out there is probably a very low percentage of folks buying $1 million houses, especially if you go and look back before the Fed started raising interest rates. The low on a 30-year was 2.65 over the last, call it 7 years or something like that. If you can borrow at 2.65 and buy an asset like that you're going to live in, you're going to do that all day long. Now you're going to do it much less at 7% 30-year, right? And the folks that might want to trade up into $1 million home when they have a 30-year mortgage, let's say on a 500,000 or 600, they're just not going to do that at 7%, right? Because how much appreciation did you have? You might have even taken a home equity loan before you saw rates, move much higher, because there was a lot of telegraphing of that. So I look at the XHB and I say to myself, this thing looks like it might want to break that uptrend that's been in place. And so we'll see. I also wanted to highlight, Guy, United Airlines. It doesn't look too different than this. So some of the transports, they've had, these nice runs. Does not look pretty similar in a way. And these are some of the technical levels that I think make some sense. Look at where that is breaking, right at that uptrend and right at the 200-day moving average. So, a lot of the headlines about air travel, are not particularly great right now. And again, maybe that has nothing to do with individual, activity on some of these names, but some of the technicals I think are worth checking out here.
100%. And I think that trend line is valid. We got a question because you mentioned this, I think, on Fast Money last night. I think Carter Worth wrote a note about it, but also Aaron Pugh's asking about Pepsi. Mentioned a double bottom yesterday. I know we looked at it last night on the set of Fast Money. Let's take a quick look at the Pepsi chart, because we actually might have just, for the first time in a while, found a bottom. Again, you got to go longer term than that, but this could be interesting here, Dan. For maybe if you draw that horizontal line across from I think the winter of 2021. There you go. I mean, that's worth looking at here for sure.
Yeah, I guess the bad news is like, if the stock market's going to rally, then, staples or some of these more defensive sectors are going to be, less interesting. It used to be somewhat of a yield thing. I mean, the yield on Pepsi is 4.34% with the stock down here. So maybe that gives you a little cushion. We are not in the camp, that says, buy stocks for high yields. I mean, sometimes you'll see an allocation towards that, especially when you see, the sort of rate situation that some folks thought we were going to be in, and we're just not in that right now. So, 4.34% is not that interesting versus a 4.55, U.S. Treasury, which supposedly, maybe not, Moody's doesn't think this, supposedly that's a take it to the bank, like not defaulting sort of situation.
We have a question from Gary Webb. There's a 20-year auction today. I think it's $16 billion-ish. And his question is around sort of some of the performances we've seen around these auctions. They've been a lot better than expected. And what he's saying is the prearranged favorable outcome orchestrated by best. And by the way, I'm not big on conspiracy theorists. This is one I happen to believe. I guarantee you the Treasury's been back, sort of backdooring or backrooming conversations about these Treasury auctions and saying it's in all of our best interests, if we're not going to see foreign buying, for you banks out there to participate. So it would not surprise me to see a decent auction today, despite what's going on in Japan and other things. But with that said, going back to the original part of this show, which you might want to name this show, doesn't mean I don't think rates are still going higher.
Yeah, I mean, again, we know where stocks were trading the last time we saw 4.8%, on the U.S. Treasury yield. And listen, maybe folks, who are buying stocks here, get comfortable with all those sorts of things. I think it's sort of the macro dislocations, and that's what we had in early April, could cause the downward volatility in stocks. But right now, Guy, and going back to the word that you used and Jamie Dimon used, and a VIX that's trading where it is or whatever, it just feels like it's one of those periods where we had the shock and awe. You know what I mean? We had the thing that shakes a lot of folks out. You kind of, you get to a point where what's the pain trade here? You know what I mean? And it seems to be to the upside. We have a VIX stuck at 18. A friend of mine who writes a really good newsletter, the GFR newsletter, his name is Jorge. He was talking about VIX expiration today, and a lot of the open interest is at that 18 level. So you've seen things kind of pin towards that. He's also in a camp where, and I know Carter thinks we're going to fill in a gap to the upside. We talked about his trade, or at least his charts the other day. Jorge also feels like that gap that we just talked about in the S&P 500 is probably something that gets filled in the not so distant future. I guess what I'm interested in is like, what sort of price action do we see if we head back towards that kind of 5,600 level in the S&P 500? Do we have a VIX that's over 20 or 22 or something like that? Do we have a 10-year yield there? Do we have a US dollar breaking through that 98 level in the Dixie, that sort of thing? If it's just a little, kind of back and fill in the S&P, then maybe we don't see all those macro dislocations.
Before we get to Butters, Amanda did another great job. The call of the day, and this is around UNH, which everybody's seemingly offsides. And I'm not sort of picking on this one analyst, but HSBC, Hong Kong Shanghai Bank, I believe that's short for, you probably know better than I. They cut their price target to $270 from $490. Think about that for a second. And that suggests about another 15 to 16% downside from here. And they're pointing out that the valuation is attractive, but there are obviously some other things going on. So I don't know if this is particularly helpful for people that have been long the stock the entire way down and then have sort of this rug pull. I think the average price target is still about $380 in UNH, which is probably still too high. This 270 suggests now the lowest price target on the street, but we mentioned UNH obviously because of its size. And when you see a company of this size and magnitude and importance move in the way that it has, basically, Dan, since I want to say April 11th, when it was a $600 stock, been cut in half in the course of a month, that's a problem. I mean, to me, that's a problem. I don't know. But obviously, the market doesn't seem to care.
All right, really quickly, let's throw up, and you talk about HSBC downgrading the stock at this point. Just look right there. This is per FactSet, 21 buys, 5 holds, 3 sells. So to your point about people being offsides, that's like exhibit A for that. Let's just pull up a year-to-date chart, Stephen, because I just want to show a bar chart, on this one. So yeah, let's even zoom in a little bit more. I want to just see the price action. All right, so you had that first gap that was on earnings. The second gap, Guy, was on, like, I think it was SEC investigation of certain practices. You saw the stock get all the way down to 250. Now let's do a 10-day chart here, because I think what's interesting here is that you had that gap to the stock traded down to 250 right there. Okay. So, and then you saw it, so it opened at that level, closed all the way down to 250. And then the right bar, as you see that's where it closed. That's the spike. Okay. Then you see the stock the next day open just above the close, right? And then you see there was some volatility there, but it closed very near the highs. You saw the follow through. That's what we call a spike bottom formation. Okay. So the trade is done. It filled in the gap. You know what I mean? Then your guess is good as mine. Like, does that make some sense? We talk about technical patterns. That is a classic spike bottom. And it's just something that's interesting to identify. All right, guy, last thing here. If it's Wednesday, what do we do on Wednesdays?
Well, Wednesday is Sunday at Carvel for you people of a certain age. That would be me. You used to go to Carvel, but if it's
I still
Wednesday
go to Carvel, by the way. I love those flying saucers. I'm usually a chocolate guy in front of those, in the middle of that.
The flying saucers, the saucer part of the flying saucer, that's what they use for the crunch in the middle of the cakes. They just crumble them up.
Okay, love it. Let's do Butters here, and this is
Amanda's saying something. Hold on, she's mad at me about something.
It's fine.
Set up the Butters better because we have to clip this.
Okay.
By the way, CC was saying there's some crypto thing in
Conference.
Las Vegas, some conference that might be some excitement into that. Anyway, back
All
to
right,
you.
so on Wednesdays, we get a preview of the Earnings Insight blog that is written each week by our main man. Well, let me do that again. If it's Wednesday, it's Butters. We get a preview of the Earnings Insight blog that drops on Friday mornings. You can have it in your email box in the inbox, factset.com/insight/subscribe. John Butters, who is the senior earnings analyst over there, we get a preview of it. This is on Wednesdays, and this is some good stuff here, guy, because we're getting to the tag ends, as they say, of S&P 500 earnings, and so only 6 S&P companies have withdrawn their annual EPS guidance for fiscal year 2025 during the Q1 earnings season. By comparison, 185 companies withdrew their annual EPS guidance during the Q1 of 2020. That was obviously the COVID lockdown. That number, guy, sticks out to me like a sore thumb, especially when you think about the volatility that we had, okay, at the start of Q1, and we had a lot of big companies still reporting in early April. So they were just in the first few days or the first week of, Q2, if you will. 6, I wouldn't have told you. If you said, gun to your head, how many withdrew for 2025, given the fact that Liberation Day was that first week and all the volatility happened, the week after, I would have told you dozens. I don't know if I would have said a couple hundred, but I would have said dozens.
185 during COVID was obviously a bit of an anomaly, but it made sense. By comparison, 6 in this environment does not make any sense to me whatsoever. I would have said you put a 0 at the end of the 6 easily, and obviously I would have been wrong. So, and it's funny because I think we've been living through this, and it feels as though, just to me, you've been hearing a lot more companies pull guidance, or whatever term you want to use, give a different set of guidance, one for a normal environment, one for potential recessionary environment. But 6 seems dramatic on the downside to me. But Butters does the work, and it is what it is. So, yes, label me surprised by this.
All right, 242 companies have provided fiscal year 2025 EPS guidance during the Q1 earnings season. More than half of these companies maintain previously issued guidance. Okay, so it's one thing to actually just kind of reiterate your guidance. It's another thing to raise your guidance. You and I didn't expect a lot of big, beat and raises during that quarter. But, if you're uncertain, the idea of lowering guidance, okay, so he's just saying, about half of the S&P 500 just maintained. I think that's interesting. Only 36 of these companies issued fiscal year 2025 EPS guidance below their previous guidance. So if you would ask me again, okay, how many lowered guidance, I would have said dozens. Now, if we can do the math, 36 is how many dozen, guys?
3 dozen.
Okay. Do we have a word to describe other groups of numbers in the English language? You see what I'm doing here, Bill? This is the Nate Bargatze sketch. This is the one, Washington's Dream. Guy still hasn't watched it. He said, we will make up words for groups of numbers in our new country. And the first one would be a dozen. They say, how many others will we have? And he said, none. It's a really funny joke. We're going to put that in the show notes because our main man, Jacob, who used a term that is near and dear to your heart. What was that name?
Slapdick.
Yeah, Jacob, thanks a lot for that. Okay, so 36, that's 3 dozen. There's no other word in the English language that describes another grouping of numbers. But again, that's a number that I thought would have been much higher, guy.
Again, I apologize. I don't know. You just talked for 45 seconds. I don't know I really have no idea what you're talking. Typically, I have a little idea and I just sort of feign ignorance. This time it's full bore ignorant. I don't know what you're talking about.
Bill knows what I was talking about. Great stuff by John Butters. Okay. If you want the Earnings Insight blog in your inbox, you know where to go. factset.com/insight/subscribe. Thank you very much to John Butters. I think the last big name in the S&P 500 that we're all waiting for, that's NVIDIA.
That's the NVIDIA.
That's next Wednesday after the close. I'm going to preview it with Gene Munster of Deepwater Asset Management. That's going to be in the Risk Reversal podcast feed on Wednesday morning. Great stuff here today, guy. I know you didn't understand a lot of the stuff out of my mouth, but I enjoyed it. Sometimes as you say, you need that. An audience of how many?
1. I do that every night. I know this.
Okay.
By the way, Nick basketball tonight. This is the Eastern Conference Finals. So last night, the Western Conference Finals started, and the Oklahoma City Thunder emerged victorious against a very good Minnesota Timberwolves team. I think OKC wins this in 5 or 6.
Whoa.
Coming back here, these are two teams that have history. And I was watching something on the ESPN earlier this week about the history of the Knicks and the Pacers. And it is a storied history going back to the Reggie Miller era. So stay tuned, folks.
No love lost.
No.
And Reggie, he calls the games too.
Listen, Reggie Miller was a stone cold assassin, and he loved jamming it up the Knicks. You know what? And I respect that.
Yeah,
I respect that.
All right, great. This was a great market call. We're going to be back tomorrow at 11 a.m. We also have a great podcast. I don't know that it's great. We haven't done it yet.
We haven't done it yet. It could suck, but chances are it's going to be really good.
Every quarter, Mike Wilson of Morgan Stanley comes on with us. We love those conversations. That's going to drop Friday in the Risk Reversal podcast feed. Thanks a lot. Thanks for being here, Guy Adami. See you, brother.